I knew I was screwed the minute I saw the spreadsheet labeled Q1 forecast, AI generated. It wasn't just wrong, it was dangerous. Line 14 claimed we had a surplus. I blinked, ran it again, and my gut twisted tighter than my last decent bra strap. There was no surplus, there was a hole. And I'd spent 10 years keeping us from falling into it. Before we go further, if you're listening to this and haven't subscribed yet, hit that follow button and like the story. 97% of people don't, and it means the world to the team bringing you these tales. Anyway, they used to call me Old Faithful, like I was some national landmark instead of a living, breathing woman who'd built financial duct tape strong enough to hold together 3 failed mergers and a CEO who once tried to expense a ski chalet in Vail as client outreach. My name's Donna, and for 10 years I was the quiet spine of Fisher & Ryan's finance department. Not the loud one, not the flashy one, but the one who made sure payroll didn't bounce and vendors didn't show up with crowbars. I outlasted 3 CFOs, one who ran off with an intern, one who tried to automate the entire budget in Excel macros, and one who just plain cried in the break room. I patched every gap. I balanced liabilities like a circus act with a migraine. You want to know how bad it got once? We delayed bankruptcy by moving around 37 cents in rounding differences until a wire hit. I could find a missing comma faster than most could find their stapler. Then came Madeline. Madeline of the endless LinkedIn posts and crisp white blazers. Madeline, who once leaned over my desk and asked, "Wait, is EBITDA the one before or after taxes?" This was the woman whose daddy made her VP of operations the day she got her MBA from a school with a website that looked like it was built by someone's cousin in 2004. But she had big plans. "We're modernizing," she told the board. "Streamlining." I had to smile and nod while she pitched cloud-based nonsense like it was sliced bread. I tried. God knows I tried. I documented everything. Created a guide so detailed it made war and peace look like a cocktail napkin. I annotated every damn workaround, how we deferred invoice recognition, buffered tax exposure with rolling escrow models, and kept the bank off our backs with something I called "don't look too hard" accounting. You know what Madeline did with my guide? She flipped through it once and said, "We don't need the legacy hacks." Legacy hacks. That's what she called the reason this company hadn't turned into a grease fire by Q3 of any given year. Then came the handover. Not a retirement, not a promotion. A polite shove with a cardboard box and a signed NDA. "You're just too expensive," she said, as if I were a Gucci bag instead of the only thing standing between her balance sheet and a forensic audit. I nodded. Took my briefcase, left the access token on the desk. She smiled like she'd won. And I walked out, knowing something she didn't. The system she thought could replace me didn't even know where the trap doors were buried. I should have known the end was coming when she started using words like scalability and agility in every other sentence. Madeline talked about digital transformation the same way a toddler talks about flying. No concept of gravity, just vibes and finger paints. She stood in the conference room one Monday, wearing a blazer too crisp for someone who didn't know the difference between accrual and cash accounting, and said, "We're moving everything to new ledger, full SaaS integration, AI-based compliance by Q2. I swear to God, half the room clapped. I didn't. New ledger, I'd seen their demo. It was slick. Sure, lots of charts and dashboards and cheerful people with names like Chad explaining how financial clarity could be achieved with 2 clicks and a machine learning model trained on coffee shop receipts. It couldn't even process our vendor splits from 2017 without vomiting errors. One time, I fed it a transaction from our Thai logistics supplier. It categorized it as restaurant. The software thought we were having pad thai instead of moving $500,000 in bonded inventory. I flagged the issues, created a sandbox to test compatibility with our legacy framework. It flagged 117 mismatches. I labeled them one by one, wrote a plain English guide so simple even her marketing guy could follow it. She skimmed the intro, laughed, and said, "We don't need the legacy hacks. Legacy hacks." That's what she called the cumulative knowledge of 10 years patching holes in a ship held together with crossed fingers and my insomnia. The only reason our credit score hadn't been torpedoed by a single misclassified liability, because I built custom shielding logic to defer risk over rolling quarters, using vendor offsets and staggered amortizations the software didn't even have a vocabulary for. I was doing the job of 3 systems and 2 full-time staff, quietly, with a stiff neck and a drawer full of protein bars because I didn't have time to eat like a normal person. But to her, I was just overhead, something that didn't fit the new brand image, so they slid a manila folder across my desk. "We've restructured your position," she said, voice sugar-dipped in corporate HR. "Consultant status for knowledge transfer only, temporary." I didn't blink, just nodded and started printing. I backed up the reconciliation trees, tagged everything I could salvage, and wrote my final notes in a separate doc titled, "If You Care About Surviving Q4." The next week, they let me go. No exit lunch, no card, just a tight-lipped escort from HR and a final comment from Madeline. "It's not personal. You're just too expensive." I smiled, took my briefcase, left the security token on the desk. But what she didn't realize was this: that token didn't unlock the vault. I did. It took less than 2 weeks for the cracks to show, and another 3 days for them to start caving in on themselves. Fisher and Rhine had lined up a tidy little cross-border acquisition, something shiny and European they could parade around to the board like a purebred show dog. They needed a bridge loan to cover the float. Routine stuff. If your books aren't a glorified illusion held together by a woman you just fired for being too expensive. Turns out, New Ledger didn't know what to do with Line 37. Line 37 was always tricky. Intercompany receivables buried under a shared risk structure tied to freight hedges and deferred VAT on reclassified goods. But I'd built a patch. Manual, yes, but airtight. I'd written a conditional entry protocol reconciled across 3 systems that made sure the numbers sat clean and untouchable until both currencies settled. If you didn't know it existed, Line 37 looked like a misstatement. If you tried to override it without the patch, it looked like fraud. And that's exactly what the bank saw. Anomaly, discrepancy, mismatch. A junior analyst flagged it. "Where's the Line 37 patch?" No one could answer. New Ledger said error. That's all it said. No explanation, no fallback logic, just a red box and a cheery tooltip that read, "Please contact your system administrator." Madeline, she waved it off. "Probably a legacy bug," she told the bank. Legacy, that word again. It was gonna choke her one day. They pushed forward with the application anyway. But bankers aren't stupid, and anomalies don't go unnoticed. Not when they're the ones wiring 7 figures across borders. That's when I got the email. Polite, crisp, from someone in lending risk at Callister Bank. Just one line. "Is it true you handled the off-book remediation protocols?" I stared at it for a long while. No greeting, no signature, just that question. The kind you don't ask unless you already suspect the answer. I didn't reply. Didn't need to. Instead, I opened a folder I'd kept zipped since the day they walked me out. Found one document. Forwarded it with no message, no commentary, no attachment note. Just a subject line. Termination clause, internal knowledge dependencies, section 12B. I added a read receipt. Watched the status flip to opened 36 seconds later. Then I closed my laptop and made tea. No satisfaction, no smugness, just silence. Because the math was already doing what I never had to say out loud. They started digging like raccoons in a tipped-over trash can the minute the loan froze. Desperation doesn't wear a suit. It sweats through it. They combed through every network drive, hunted down old flash drives, called 3 interns who hadn't worked there since TikTok was still musical doily. One of them, bless his heart, apparently said, "Donna had a naming system, but you had to know the scent trail to follow it." Kid always did get poetic when he was nervous. They reached out to a vendor I'd once stayed on the phone with for 4 hours during a failed tax conversion. His response? "If Donna didn't give you the fix, you don't have the fix." Because here's the thing no one tells the Madelines of the world. Software doesn't remember who it owes favors to. And I didn't build a system. I was the system. The variance patches? All manual. The cascading deferral buffers? A nested logic flow I kept in my head because the system couldn't handle circular dependencies. The temporary escrow toggles? Triggered by 3 variables across different time zones. Something no AI model has been taught because, surprise, humans don't behave like algorithms. But what sealed the coffin wasn't my silence. It was section 12B. The clause that lived quietly in the shadows of my original contract, signed back when the company was teetering on the edge of insolvency, and the founder had the good sense to ask me what I needed to keep the lights on. I had written it myself, slid it in on page 13. Nobody ever reads page 13. If critical financial continuity measures are non-transferable via automated systems, termination without transitional oversight invokes auditor liability for any subsequent miscalculations. Read that again. It means, if they fired me and the bots couldn't figure out my math, the auditors take the hit for everything that breaks. It had never been tested. Not once. Because for a decade, nothing broke. Until she decided, we don't need legacy hacks. And now the whole place was digging through half-archived directories like the answer might have been misfiled under D for don't screw with Donna. They called. They emailed. They even tried to slide an NDA update into my inbox like I wouldn't notice. I didn't reply. I just adjusted my watch. It was almost time. It started with a whisper. One of those internal murmurs you can hear even through a firewall. A flagged note here, an unanswered reconciliation request there. Then came the big one. The bank's due diligence turned into a full forensic review. Not just a numbers check, an autopsy. They found it fast. My patches had buffered $6.2 million in liabilities across 5 fiscal years. Legitimate? Yes. Disclosed? Not in the new system. Because the new system didn't have a box for workaround performed by one overcaffeinated woman with a grudge and a god complex. Without my manual logic, the books looked like someone had been cooking them with a blindfold and a whisk. Quarter-end variances that used to settle into silence now screamed across the balance sheet. Deferred payables that once rolled cleanly into vendor credits were showing up as orphaned debts. Even the automated forecasting model had started spitting out nonsense. A 12% growth prediction with negative net cash flow. The kind of thing that makes a banker sit back, cross their arms, and ask, "Would you care to explain this circus?" The lead auditor sent a follow-up. Professional, clinical. Why weren't these reconciliations disclosed during onboarding of new systems? Legal's response? A 7-second pause. Then the sound of someone choking on their own spreadsheet. I imagine it was Madeline who panicked first. She always thought a pretty slide deck could outrun a ledger. She tried stalling, then spinning. Historical artifacts, she called my logic buffers. Non-essential legacy functions. The bank wasn't buying it. She called me that afternoon. Straight to voicemail the first time. Second time, I picked up. Her voice was taut, fragile like a balloon stretched too thin. "Donna," she said, "can you come in? Just to explain a few things. We're trying to clarify some legacy reconciliations," and I cut her off gently. No anger, no venom, just the clarity of math finally landing like a gavel. Per Section 12B, I'm no longer obligated to provide legacy continuity, I said. That decision was made when you terminated my role without transitional oversight. Silence. Not the kind that waits for a reply, the kind that knows one won't come. She cleared her throat. I didn't realize. That's the point, I said. I didn't raise my voice. I didn't curse or accuse. I just hung up. Because I didn't have to speak for the numbers anymore. They'd found their own voice. The bridge loan collapsed like a folding chair under a linebacker. No lender wants to throw good money after financial guesswork, especially not when the math comes with footnotes like, estimated by AI confidence range, 62%. The bank pulled out. Quietly. Cleanly. No press, no explanation. Just a polite silence that echoed louder than a slammed door. Then came the vendors. Suddenly, the usual net 45 payment terms got slashed to net 10. Some demanded cash up front. One emailed Madeline directly with a subject line that read, "Do you even know who used to run your numbers?" Spoiler alert, she didn't. She never had. And now, she was discovering that goodwill isn't something you inherit. It's something you earn, one manual patch and one crisis averted at a time. The software, bless its binary heart, tried to compensate. It crawled the old ledgers and started guessing, literally guessing, what my logic might have done. AI-based backfilling, they called it. The machine assigned probable values to half a dozen line items that I used to treat like live wires. One of those guesses triggered an internal fraud flag because it looked like someone had smuggled in a false payable to offset a $250,000 exposure. The insurance carrier caught wind of it, sent a memo that said, in effect, "Until we get clarity on how your ledgers were constructed and who maintained them, we may need to reevaluate past coverage, retroactively." Translation? One bad audit and they'd lose their entire D&O protection. That's when she cracked. Madeline sent me a message, not formal, not filtered through HR or legal this time, just raw desperation in sans serif. "Please, just tell me how you handled line 37. Line 37 again. Always line 37. The graveyard of every overconfident executive who thought numbers bowed to automation. I didn't respond. I archived it. Then I opened a blank document, titled it "When Systems Forget Their Builders," and wrote the cleanest 1-200 words of my life. I didn't name names, didn't mention Fisher and Rhine, but if you'd ever read one of our annual reports, you'd recognize the figures, the phrasing, the deliberate absence of certain values, the unmistakable shape of a ledger maintained not by luck, but by vigilance. The article went live at 9:47 a.m. By 10:15, it was being passed around LinkedIn with comments like, "Oof," and "This hits close to home." By lunch, someone had turned it into a panel topic at a finance webinar, "The Risk of Replacing Institutional Knowledge Too Fast." And me? I ate a sandwich in peace because I wasn't sabotaging anyone. I just stopped saving them. The free fall started quietly. They always do. Just a few skipped beats in the monthly reporting cycle, a jitter in the variance tracking. Then the alarms started going off, internal ones this time, the kind no one can hit snooze on. The board called an emergency session behind closed doors. No press release, no smiles, just panic and business casual. I wasn't there, of course, but I heard enough from people who couldn't stop whispering. The founder showed up in person. That alone was a red flag. He hadn't been seen in the office since they replaced the vending machines with wellness stations. He sat at the head of the long walnut table, glanced at the projections, and said one sentence: "How did we lose our own math?" That's when a junior analyst, I wish I knew their name, I'd send them cookies, started digging through archived contracts. They found Section 12B inside the 2014 Emergency Contingency Annex. The clause, the trigger, the one they all signed and none of them ever read. You could almost hear the oxygen leave the room. 3 days later, the general counsel resigned. Personal reasons, they said, but let's not kid ourselves. No lawyer wants to be in the blast radius of that kind of clause, especially one that says, you can't sue the woman you fired for not being a robot. I heard they halted all pending system transitions, froze every migration file, locked down admin credentials, yanked New Ledger's API integration like it was laced with anthrax. Someone even suggested dusting off my old reconciliation tree, but they couldn't find the root logic, because the logic wasn't in a file, it was in me. Madeline? She didn't resign. She got reassigned. A polite HR shuffle to special projects, which is corporate code for sit in a corner until we figure out what to do with you. No title, no oversight, no more shiny pitch decks. A week later, I got a message from a number I didn't recognize. Said Greg B. I stared at it for a second. Then I remembered. Former board member, finance guy, always carried those little notebooks that made him look like he was journaling his feelings when really he was tracking EBITDA like a Vegas bookie. He invited me to coffee. We met at a place downtown, quiet, classy, the kind with real mugs and uncomfortable chairs to keep turnover high. He sat down, no small talk. Just looked at me and said, "We didn't realize you were the architecture." I took a sip of my black coffee and shrugged. "I was never trying to be," I said. "I just didn't want the place to burn." He nodded slowly, like someone realizing the fire had already happened, and I was just the one who stopped pouring water. I didn't ask for anything. No apologies, no offers, no favors, because I didn't need to watch the collapse. I'd already moved out. The first client to walk was Middleton Imports. I saw the change notice in a trade bulletin. They were polite about it. No drama. Just a clean line. Effective immediately, Middleton has terminated its financial advisory relationship with Fisher and Rhine. No reasons given. No blame assigned. But the next morning, my inbox lit up with a message from their VP of Finance asking if I was available for a long-term consultation. I didn't rush to reply. I let it sit a few hours. Not out of spite, just timing. Precision. Let them understand they were walking into a room, not summoning a ghost. By the end of the week, 2 more clients followed. 1 logistics firm, 1 legacy manufacturer. All 3 had been part of Fisher & Rhine's core book of business for over a decade. They didn't post cryptic tweets or make vague jabs on LinkedIn. They just vanished. Quietly. Surgically. And then they reappeared in my office, or more accurately, in the inbox of my new firm, D. Merrill Strategic Advisory, registered 6 months before Madeline ever said automated compliance, incorporated out of a simple LLC. Built with the same discipline I brought to my spreadsheets, quiet, exacting, lethal in the right hands. I didn't send out press releases, no website launch, no "we're excited to announce" post, just contracts, signed, scanned, filed. And somewhere on the other side of the city, Fisher & Rhine's remaining partners started to sweat. Because this wasn't about Donna taking clients, it was about clients leaving them, willingly, wordlessly. Because institutional memory isn't something you replace, it's something you earn. A few days later, someone at Callister Bank reran Fisher's suspended bridge loan application. I know because a redacted copy of the report ended up on my desk. Don't ask how. It had 1 new annotation. Risk factor, missing manual financial continuity expert. No name, no footnote, just that. And then the founder called. Not Madeline, her father. The man who signed my original contract, the one with the 12B, the one who used to nod respectfully when I handed over ledgers and never once asked if I'd explain them. He sounded older, like someone who had just realized the foundation under his feet was made of one woman's calculations and a decade of overlooked brilliance. "You were right," he said. I could have said, "I know." I could have said, "I warned you." But I didn't. Instead, I sent him a proposal. 4 pages, itemized, triple my old rate, scope limited strictly to reconciliation advisory, no training, no hand-holding, no second chances. He signed it within the hour. No edits. The old world hadn't collapsed. It had just shifted, bent, slowly, back toward the woman who built it. I still sit at the same desk, heavy oak, dented from years of elbows and late-night coffee mugs. Same pen, too, a worn-out Pilot G2 that somehow still hasn't run dry. But the name on the door isn't Fisher & Rhine anymore. It's clean. No serif fonts, no clunky logos, just 3 words. Merrill Advisory Group. Clients don't come in with lies wrapped in spreadsheets anymore. They walk in open, vulnerable, books laid flat on the table, no dancing, no spin. They know better now. They know what happens when you treat foundational knowledge like a line item. I don't fix disasters anymore. I prevent them. No more hacks. No more holding broken systems together with gum and institutional guilt. What I build now doesn't need patches. It breathes. It lasts. One afternoon, after a routine vendor audit, I found an envelope on my desk. No stamp, no return address. Just my name, handwritten in that bubbly, barely controlled cursive I'd recognize anywhere. Madeline. I didn't open it right away. When I did, it was short. 2 sentences written on expensive linen paper. None of us thought you'd leave quietly. You always seemed like you needed to fix things. That was it. No apology, no explanation. Just the quiet gasp of someone who assumed I'd be waiting in the wings forever. I didn't reply. There was nothing left to say. But I did something else. I printed the letter, slipped it into a manila folder labeled Assumptions, filed it right next to a laminated copy of Section 12B, sealed behind plastic like a holy relic. Sometimes, after hours, I open that drawer, not out of spite, out of memory, because legacy isn't just what you build. It's what survives when you stop showing up to explain it. She thought I'd burn the place down when they let me go, but I didn't. I just walked away and let gravity do what gravity always does to hollow things. No fire, no revenge, just clean books, clear terms, and a name on the door they can't erase this time. Legacy code doesn't break. It waits until the new system realizes who wrote the rules.